Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. And today we want to shine the spotlight on the healthcare sector. And can it star again in 2020? Paul, well, you're the man who's going to answer the question, but let's start off by summarising what the healthcare sector is.
Okay, let's look at the sector, Peter, because it is now the third biggest sector on the ASX with a market weighting of 10.4%. That's after financials and materials. It was about half that a couple of years ago, Peter, so it is really important. It's the best performing sector over the last 1, 2, 3, 5 and 10 years. It's massively outperformed the rest of the market, as that table shows. So last year, 2019, 43.5% versus the market's 23.4%. That includes dividends, so almost a 20% outperformance. But look at that return over 10 years, Peter. 19.2% per annum on average, compared to the market's 7.9%. That's more than almost 12% difference on a per annum basis, averaged over 10 years. So on each of those 10 years. Yeah. So a phenomenal difference in performance. And to be honest, Peter, we do have some world-beating healthcare companies.
Yeah, and it's funny, that chart single-handedly defends one of Buffett's most aggressive piece of advice, that only wimps diversify.
Yeah, it does indeed. So let's actually talk about some of our companies. Now, obviously, you can't talk healthcare without CSL. No. That's now Australia's second largest company, probably not far off being Australia's largest company by market capitalisation. It does dominate the sector, Peter, at almost 2/3 market weight, so it's largely down to CSL. It's the global leader, of course, in blood plasma products, and number 2 globally in influenza vaccines. But it's been a fantastic performer and the best performer on the ASX over the last 2 decades. So it is CSL, but we have some other fantastic companies. Cochlear, the ear implant, and of course everyone knows about the cochlear implant, a 7% weighting. The third largest company, Sonic Healthcare, it's big pathology company. Used to be very big in Australia, but now, of course, it has operations in the USA, Germany, UK. So it's now much more globally focused. Also has imaging. It's about a 7% weighting. Ramsay Healthcare, it's the largest private hospital operator in Australia, but also it's big in France, big in the UK, and now in Scandinavia. So more than half its revenue now comes, or almost half its revenue now comes outside Australia. ResMed with the sleep apnea, it's a leader in terms globally with those products, a 5% weighting. And another 10 companies like Ansell, Fisher & Paykel, and 8 other companies that make up under 1%. So, but there are some world-beating companies in that group.
So Paul, how come these companies have performed so well?
Well, obviously, it's the CSL factor is very, very important, Peter, because it has just dominated its market, had some superb management, more than 90% of its revenue outside Australia, and really starts. So, when you talk about healthcare, you've got to talk about CSL, and it has been a phenomenal company. But there are other stars, Peter. So, and I mentioned those already: Cochlear, ResMed, Ramsay. The thing that sort of all these companies have in common is that they are global operators. So more than 90% of CSL's revenue comes outside Australia. Same with sort of companies like ResMed and Cochlear, and even Ramsay to some extent now. They're very specialised, they're focused, and they've invested in their people. So they have done really some fantastic things. We don't see that in some other sectors in Australia. So,
and also, Paul, they're all entrepreneurial companies,
they're
apart from
all
CSL.
Entrepreneurial companies, and obviously in Australia we have some great research and universities. So that's also supported the sector. I think that's one of the other differences. But there are also just the tailwinds for the sector itself, Peter. Now we all know about an ageing population. As we get older, we need more healthcare services. But I think the one that often gets confused here is that just because of the way that things are evolving in the Western economies, there are a lot of changing expectations around things like beauty, fitness and lifestyle. And so not only are we living longer, but as we live, we're also consuming more health services. Things like knee operations or hip operations, they're commonplace today. As
Botox,
Botox,
10 years ago.
Just getting tests, getting heart checkups, whatever they are. I mean, these things just happen now on a routine basis. And of course, that's increasing demand for health services. And of course, the sector is largely paid for by the government. Now, that's important too, because it provides a very solid revenue base for a lot of these private operators. And governments around in most Western economies have been increasing expenditure, not at GDP, but at GDP plus rates for some time. So aging population, increasing demand, and basically really supported by the government sector, is one of the reasons, some of the tailwinds that support the healthcare sector.
Okay, so let's go to the big question. Can this keep on going?
Well, let's look at the arguments against, Peter, and the argument that comes up about our healthcare companies are they're very expensive. And that's true, there's no doubt about them. So when you compare data, for example, S&P looks at what they call the projected PE of the Australian healthcare sector. They say that it was trading at about 32 times as at the 31st of December. Compared to the US healthcare sector, it was trading at about 17.5 times. So on that basis, and using their definition of projected PE, quite a big difference between Australia and the US. Let's look at our companies on a more traditional PE measures. Look at forecast PEs for FY20 and 21. CSL about 45 times, going down to 39 times projected FY21 earnings. Cochlear in the 45s, ResMed in the high 30s. So very, very expensive. Big numbers. But, and here's the but, which I think is important to remember. We really do have a shortage of stocks in Australia with strong top and bottom line growth. I mean, these companies aren't just driving bottom line growth, they're growing their sales and their revenue. You look at sectors such as financials, materials with their price takers, even our industrials. Retail, you struggle to see that. Outside IT, you know, healthcare is about the only sector where there is really top line growth. So there are a shortage of stocks. Secondly, the comparison, I think, with the USA is a little bit unreliable. Our companies are very globally focused. That's not to say that the US companies aren't globally focused, but most of their revenue comes from inside the US. And there are some companies in that sector that you might question about whether they're really healthcare. I mean, Johnson & Johnson's a world leader. It's classified as healthcare. It's also in a lot of very consumer products, Peter. So there are differences between the Australian sector and the US sector, which you need some caution. And unquestionably, those tailwinds around ageing population, the demographics about we're all consuming people and government still paying more are still in place. So I think this is a sector that you've got to stick with. You know, it's expensive for sure, Peter, but it's probably one, if you're not in there, you need to get in there at some stage.
Yeah, and I think your argument in this presentation says that if there are some substantial sell-offs this year and you're not in this sector, it's time to get in it because this is the sector that's heading in the right direction, probably for a long, long time. That's Switzer Investing Insights brought to you by nabtrade. Thanks for joining us.